I wanted us to look at how businesses can operate. So we're going to start with the sole proprietorship. Um, here's a guide to business formations. I'm going to try to give you some of the types, a few of the trip ups that may occur. As we look at this, first thing you got sole proprietorship. I can be Stephen G. Bailey. Boom, I've got a job. I can be Stephen G. Bailey, DBA, doing business as, give myself a name. Very clear taxation rules. There's income and there's expenses, and you get to offset any reasonable expenses with any income. Um, Not real heavy. There's no partnership tax rules. It's all ordinary income. There may be some investment stuff that goes on, but for the most part, no. The problem, of course, with a sole proprietorship is anything I do wrong, I own it all. And all of my assets are subject to seizure by creditors, which could include anybody that I harm. Any kind of work I'm doing. I mean, even running a lawn mowing business, I hit a rock, I put that rock through somebody's window, that causes them to wreck their car, boom, we do a whole bunch of damage. Well, I'm completely uninsured. Great. Now for the rest of my life, I may be working for them. There's no corporate shell. And what we're going to find as we go through this is that we might be able to set up a shell, a partnership, or a limited partnership, or an LLC, or a C Corp, or an S Corp, and we can limit our liability to exactly what we've put in the business. Now, some of us may scream, well, that's not fair. Then I can't sue them if they hurt me. Well, if they're properly capitalized, um, it doesn't matter if they've got insurance for it. Not that big a deal. So let's look at some of the others. I mean, I think maybe spend some time looking at this bottom slide. Being a sole proprietor is not always wonderful. It's just you. Here's this happy lady who started a business, and here are a couple people who seem overwhelmed with worries. It does help to have somebody else join you. So the first type we can get to is a general partnership, and this just requires two or more people. If two or more people are doing business together, ordinarily we're just going to treat it like a partnership. A sole proprietorship has just one person in it. We can have shared liability here, but I always want to caution you that you've also got a high likelihood of I should close this thing out. Playing a stupid game. So we've got a high likelihood of complete personal liability. It may be that our partner doesn't have any assets and is going to leave us holding the bag, even though they may be the person completely at fault for it. As you might imagine, banks like general partnerships. They're not so keen on limited partnerships, as we'll explore. But because I can collect from either one of you, I can go to the two solvent ones of you. So in a general partnership, we've got to kind of be sure, is everybody in our partnership keeping their end of the game up? And my liability for them, it doesn't necessarily mean I didn't watch out over what they were doing. It's just simply their acts are my acts. There are a few exceptions to that, but not very many. One of the things we got to look at, and I've got to look at both of them, if the partnership terminates, each of us has sole and complete liability for all existing work and all existing debts. Anybody left can incur new obligations. All right, so partnerships terminate when one or more partners leave. Okay, all of us retain liability for everything that's still existing. Remaining partners essentially form a new partnership and can incur new obligations. One of the quirks in a general partnership, or one of the less desirable features of a general partnership, is death. If one of the partners dies, guess who your new partner is? It's the widow or widower and any heirs of the decedent. Um, Not necessarily a good thing. They may know nothing about your business, and all of a sudden they're in here claiming, oh, my husband had the biggest, best part of this firm. Well, here's a way around this, and I can't stress it enough. If you're in any partnership, and pretty much anything we talk about from here on, look at the possibility of a buy-sell agreement. What that ordinarily requires is that everybody agrees to finding one or two or three experts to set a value. And each time you get an expert, it's going to cost money. Set a value on the partnership. If it's a low dollar lawn mowing industry and you guys have kept good close ties on who owns what and whose mowers, whose, and all that kind of stuff, and you don't necessarily need an expert. But if you've got, say, a CPA firm where you've got 10 partners of varying states, you may need an expert to walk in and kind of evaluate everybody's business. That's possible that you can have this done internally. You can all agree to it. The real big deal is, did everybody sign it of their own free will and volition? And volition means choice. Or were they put under some kind of stress or and that could be, hey, you either sign this or the partnership's over. Might be enough to blow up this agreement. What we're really looking for in this buy-sell agreement is, yeah, we valued our partnership at $5 million, and John's share of all that $5 million was really $400,000. And then the deal is we go to the widow or the widower or the heirs and go, is that John's signature? Did John sign everything? We go through each page and shows that John's signature, blah, 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 blah. It's case closed. So what a fair number of buy-sell agreements do is they build in a kind of, if we got a record of, hey, this thing has grown at 3% per annum, we may build that in as a buyout. The nice thing in a buy-sell agreement, one more thing I want to mention, is that we can have right of first refusal so that we, the other surviving partners, get to buy that person out. It can be a lot easier to get a loan to pay that person off. We can keep all their files. We can make them all work. Those files may ultimately pay off this loan, and then each of us as a surviving partner has a bigger piece of the pie. We're going to have to rewrite buy-sell agreement, but it's something we always want to consider. How are we going to terminate our business? How do we sell out of it? I'm not necessarily going to hit every detail in this speech, and maybe I should break each thing down by slide. Another concept we've got going here is taxation. So we said on the sole proprietorship, this is just all income taxation. There's not necessarily going to be any dividends or anything else. So a partnership is what is known as a pass-through entity. The partnership sends out bills, receives money. That money is then distributed back out to the partners per partnership share, less expense. So it's less expenses. So it's whatever we incur at the partnership level. We have to take those off the top, and then we pass it out to all the partners, and they pay income tax on it. This is very different than a C corporation, which takes all the money in, takes the expenses off the top, looks at everything, then pays a dividend. In a C corp, all the owners may get a salary. Then if they own shares in the C corp, they get dividends too. So it's double taxation. It's kind of a nice trade-off to have this straight pass-through tax pass-through entity. It's been a long time since I took business law. I used to know this pretty well, but it's really kind of gone for me. You're going to need a good accountant on how do we account for all of this stuff. Next thing we get to is something called a limited partnership. These have been around a little longer in Europe than they have in the United States, but we basically are going to ordinarily, this is kind of the ordinary framework, not necessarily how all of them are. A general partner sort of manages the business. This is the person through whom all business flows. That general partner may take on the kind of the total liability of the firm, but maybe it can go to each set of limited partners to the extent those limited partners are engaged in the business that caused the liability and get them to pony up their share. The nice part for limited partnerships is that I, as the owner of a limited partnership share, can only lose up to the amount of my investment. So we see a lot of this in oil and gas type ventures where we've actually got investors who threw in, say, $100,000 each. We've got 20 of them. So we've got $2 million. We're going to drill an oil well. And the oil well comes up dry. Believe it or not, some of those people love a failed partnership because now they've got some losses that they can use in a tax setting to offset gains on other things where they're making money. That's a little more too complex for me, but the nice thing is the general partner really takes on most of the liability. The limited liability partners can only lose the money they threw in. There are other, real estate ventures do a fair amount of this. There are other forms of limited partnerships, but we're going to look at them in a bit. I'm not sure what the RULPA is, the Uniform Limited Partnership Act. The first one is 1916. These have been around for a while. They're older in Europe. A lot of times banks or any other entity that wants loans here may come to the limited partnerships and say, okay, you guys need a $5 million loan to drill this thing. We want each of you to personally guarantee the $5 million. Well, sometimes we can go back and go, no, that's not how our agreement is. We'll each guarantee 1/20th of the $5 million. So in addition to having put $100,000 in, 1/20th of $5 million, I think is another $100,000. That doesn't sound right. Something's wrong with my math. Anyway, is it $1 million? No. Anyway, it should be another. Is it? It's not 100. No, it's another. It's $500,000, isn't it? It's still wrong. Anyway, I need to plug it in. I'll pay only my share. Banks aren't real keen on that because anytime we're dealing with that many people, we've probably got 2 or 3 people who may prove to be judgment proof. Now all of a sudden we gave away $5 million. We only have a chance to recoup, say, $4.5 million. Not a good outcome. Bank examiners don't like it either. So, the favorite for most of them is to treat this like a general partnership, but they don't necessarily have to do this. And, for any of us wanting to, maybe do a real estate development, having limited partners there who throw money in can be a great thing to do. And we can offer them pretty good share payouts every time we sell a lot, every time we sell a developed or a spec home, or every time we may be doing the contracting work on homes as we're building it. That kind of stuff. So used a lot in kind of investment schemes, if you will, where we have a general partner management. I think Trump has a lot of these. President Trump has a lot of these. His firm knows how to do development. Well, but they don't necessarily want to have all the liability. Well, what they'll do is they'll get the limited partners to put all the money up. If it goes belly up, generally under the Trump organization, the Trump people don't owe the money. They didn't put any money in. All they put in was their expertise, or they put in a little bit of money, but the extent of their liability is boom, whatever they put in. There's just no other money. There's no other assets that we can necessarily go at because that's not how it was structured. Always a little bit of shakiness there against third-party lenders, particularly those that are innocent. But if it's properly capitalized and fits the general outlines of this kind of behavior, that's the end of it. Whatever money was in there is all there is available to creditors. So we can see, I think, we can begin to see, we probably need something else. We need something more for the actively managed company, the LLP, the LLP, the limited partnership, is not entirely for speculative ventures, but that's where it tends to be used. LLCs and LLPs are for kind of continuous businesses. Think law firm, accounting firm, doctor's office, dentist office, real estate agency, other stuff. So this is oftentimes the way we see companies grow is sole proprietorship. Then once they get a decent footing, whatever it is, I'm making $50,000 a year. Maybe you ought to start looking at, let's get an LLC going. It's a pass-through entity, same treatment as a general partnership. Beautiful thing here is limited liability. Again, like the limited partnership, whatever you've put in is what you're going to lose should it go belly up or should claims get to a certain level. I'm going to skip down one and talk about pierce the veil. Well, no, I'm not. One of the nice things in an LLC nowadays, we can have just one person. When they were first put together in about 1984, 86 in Montana, they required 3 people, but slowly the states have recognized there's a lot of need for one-person LLCs. Let's just go with it. Let's see what happens. We've had 30 years of testing of LLCs, and I'm not aware of a lot of piercing of corporate veils. Now, what happens in a piercing of a corporate veil is we're going to oftentimes look to, is this company really the alter ego of an individual? So while we've got a kind of corporate shell, an LLC, is it really Steve Bailey? And should we maybe be able to go after Steve Bailey's assets? Well, one of the ways we can get around that is maybe I have enough insurance or I have sufficient assets that can be seized, that are placed into the LLC, that I can reasonably satisfy the claims of most creditors, 80-90% of my creditors. And courts are not necessarily real eager to pierce the veil because the statutes have said, hey, people can operate this way. If I'm doing it according to Hoyle, I may be okay. Be aware that that issue is there. It's a little more prevalent with corporations, but it is potentially there. I've got a note here, personal guarantees versus are we going to go after default? So this is kind of the caution to the banker. Don't expect that you're going to always be able to pierce the veil. You may, if you're going to sit here and loan me on a $50,000 business, $5 million. If I'm making $50,000 a year on this and you're willing to loan me $5 million, you may really want a personal guarantee on this because 3 years down the road, I've only made $150,000. I've probably only paid back $30,000 on your $5 million loan. And I may decide, the business is not growing, I'm walking away. I'm probably going to walk back and I may pay back the loan, or I may have sunk it into a bunch of equipment. And now the bank owns that equipment. Great. In a bankruptcy type setting, when we get to bankruptcy type settings, you're lucky to get 40 cents on the dollar. And a lot of times you only get that because you own the asset yourself and you can sell it personally. But, think about it. You drive a pickup truck, brand new pickup truck off the lot. It's a $50,000 vehicle. What's it worth the moment it hits the street? About 10 grand less. You're already at 40 grand, even though maybe you still owe the full value. All right. So I hope that makes some sense. The next part of this, at least on this slide, is fiduciary duty. So we've got a couple of different ways we can look at this in an LLC or an LLP. And maybe let me back up a second. In an LLC, we can only have that shell. In an LLP, limited liability partnership, we can actually have a series of limited liability partnerships. Pardon me, I've got to check my next slide to see what I've got. And a lot of law firms do this. So let me pause and go back there. What you'll see if you go to Thompson Coburn, which is a pretty big law firm, and it may have changed its name recently, Hush Eppenberger, others. Oftentimes what they have is they've got their trust and estate department, they've got their taxation department, they've got their litigation department, they've got their criminal litigation department, they've got their corporate drafting department, real estate drafting department, boom, 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 boom. What they have is little kind of silo LLPs, all of which are members of a big LLP. And generally the way this works is the little LLP that did the service, that caused the loss, that's the extent of liability for everybody else. Now, of course, in looking at this pierce the corporate veil deal, maybe we've got to have a giant umbrella policy that would pay reasonable sums for losses based on our real experience of what our clients might lose because we do something wrong, embezzlement, other stuff. Usually if it's intended or expected from the standpoint of the insured, like embezzlement is, there's no payment. But we can get embezzlement insurance because we can maybe go, we've got the guidelines in place to catch embezzlement before it gets too bad, so that really the payouts are minimal. They're $50,000 thereabouts. And the insurance company may charge us a pretty big premium to have that sitting there, so that they're not necessarily out money. They're just kind of holding it for us, or we can build it ourselves. So anyway, let's look then at fiduciary duty. The definition as I think of it for fiduciary duty is I owe you a greater duty than I owe me. So the place we see this the most is in a trust. If I'm the trustee of a trust, and it happens that I am the trustee of my mother's trust. I'm also a beneficiary of that trust. So I'm already sitting in a conflict of duty or conflict of interest, because I'd like to see her have more money when she dies, but as the fiduciary, as the trustee, I've got to make sure that the trust money that I'm helping manage is sufficient for her to meet anticipated expenses after she exhausts available assets. So, while I might want to put all this money in small cap because if it hits, boy, I'm going to be really rich, that's not putting her interest ahead of mine. That's putting my interest ahead of hers. And as a fiduciary, I've always got a duty to watch out for the person I'm trying to help. I've got to put their interests and their understanding first. So maybe you can see that in the difference here, in a member managed one, we're going to, the members, the other LLC members or the other LLP members, each have this fiduciary duty to one another. But they've got a lot more conflict going on because they've also got a duty to themselves. So there, sometimes it's a little more challenging to get pure execution as a fiduciary. That's why some outfits put another layer up. Here's our management layer. They're the fiduciaries. We can build the structure so that should anything happen lower in subsets of the LLP or with employees, the manager managed people, because they're in a fiduciary state, can pay, we can have it set up so that they kind of have the liability sitting there if they make a mistake. It kind of helps us maybe keep an eye on one another without each of us looking over each other's shoulders. We've got this other entity that does the management, if you will, of our LLC, and it's sort of a way for us to maybe build an insurance active, not insurance, but active risk management of the entity. They're the ones looking over everybody's shoulder, and they're doing this at the behest of everybody and in the interest of everybody equally. Whereas in a member managed, it's a little challenging for me to look over your shoulder in trust and estates when I'm working the tort litigation side. This one, let's go into this a little bit. One of the other ways to do business and to limit liability on the ultimate owner is a franchise. McDonald's, generally the franchise holder is the liable party. And I put this little coffee cup up here because some of you may remember the McDonald's coffee case. It's a pretty famous case, and it's an elderly lady, I believe in her 80s, goes to a McDonald's drive-up with her daughter. It's a fairly old case. It maybe started in the 80s, I think. And you can almost tell that by looking at the coffee cup. The coffee cup itself is styrofoam and a little bit flimsy looking. If you look at your modern carry-out coffee cup, it's paper. It's pretty rigid. It's got that little cool cup thing on it. The little brown handle. I had an example of it yesterday. Well, what happened to this lady is they go through the drive-through. She gets some hot coffee. In taking the lid off to put cream and sugar in it, she squeezed her thighs together or something. She held it between her laps or between her legs, and got third-degree burns in her private area. Pretty nasty result. Turns out that she was like one of 44 people who'd gotten horribly burned by this coffee. And McDonald's answer was, well, everybody likes our coffee real hot. Well, think about, you may not know this in your lifetime, but in my lifetime, we used to get coffee that would burn you. You don't get it anymore. You don't get coffee that will burn you. They've turned the temperature down everywhere. They've also gone to these paper cups. And it's because this gal got about $850,000. Now, it was reduced over time and through settlement, but that's a lot of money for a single cup of coffee to have to pay out, I think, $200 million on a cup of coffee. Most franchise owners at a McDonald's aren't worth that. They might be worth $5 million, but they're darn sure not worth $200 million. Now, McDonald's was put on the hook here because McDonald's told its vendors, you must serve your coffee at this piping hot setting. There's no way around it. Okay? That's joint and several franchisor edicts type of liability. Both the franchisee, who should have said, no, people are going to get hurt by this, and should have kept saying it until McDonald's finally woke up to it, 41 burn cases later was sufficient for that jury to go, we're going to teach you a lesson, McDonald's, and here it is. You know, but things like somebody slips and dives in the restaurant floor, that's franchisee only, unless McDonald's specified some kind of dangerous floor covering or something, everything else. All right. So the basic system here is McDonald's owns the business itself, but grants a license to individual entities to operate each franchise as an independent business under that license. And the advantage is you get all of McDonald's advertising, all that stuff comes with what you do. You're going to pay them an annual fee. That's how they get their part of their profits. You know, the advantage to McDonald's or Arby's or Lion's Choice or whatever, you walk into any of them, you get kind of the same product, right? There's not a lot of variability. It's one of the downsides for a lot of restaurants is that you can get some variability depending on which chef showed up. I certainly see this at some of the I see it at some of the franchise breakfast places I go to that you know, sometimes the waffles are great and other times they're pretty bad. At a Mickey D's, you know, I might eat 20 Big Macs and one of them is, this one's a little different. The other 19 identical. So there's a lot of good things in a franchisor stuff. But again, we've got that innocent third party. We're not, as franchisor, going to be able to eliminate all liability. A lot of it because, you know, the big McDonald's, you've got to follow their book. So I think I've spent enough time there. I hope you guys understand what we're talking about there. Let me talk. This tends to be something we use for professional organizations. This in many ways predates, well, it does predate the LLC. This is an S Corp, and what it is it's a partnership that permits corporate liability. Okay? And maybe I should jump ahead to what's a corporate liability, but basically corporate liability is my shares are worth $500,000. If we have a big claim against us and we've got to terminate this corporation, I'm just out my investment. You can't go back and get my personal assets. Now, we've already talked a little bit about some of the exceptions to this. You know, if it's too thinly capitalized, or we're not paying close enough attention to our other partners, or it's my deal and I was grossly negligent, or willful and wanton, high-level negligence, I'm going to suffer the consequence here. All right? So let's look at it. Its basic structure is that it is a pass-through entity. It gets partnership tax treatment. It can only have as members individuals, certain trusts, and estates. In the old days, when it was first passed, it was too much like a partnership. You know, technically a partnership terminates at the death of any partner. And what we have this sub-partnership that's sort of dead, that sits there and collects all the money it should collect and then dispenses to itself. And then we have a continuing partnership of the remaining partners. So we have a kind of a trust partnership and then a regular partnership. Well, with an S Corp, this got gummy pretty quickly. And they've slowly increased a couple of things. First, it used to be limited to 40 people. Now it's limited to 100, but it also lets us leave in trusts and estates. So let's back up to that buy-sell agreement. If I am an S Corp doctor, let's say, and you see a lot of doctors or doctors groups using this. You know, we may have an S Corp that actually owns a doctor's office building, and all of the doctors in that office building are members of that S Corp. And, there's just good reasons for it from a business standpoint. It sort of also lets them hold some real estate, and there's a bunch of cool stuff you can do with that. It's a little bit above the level of this course to be talking about that. And then what we might have is each doctor's office has its own S corp or its own LLC or its own LLP. Now, I want to caution that sometimes professionals aren't always able to utilize LLC or LLP. They may be forced to use either professional corporations or partnerships. You may be stuck partnership, and that's state by state law. Most states now are letting us incorporate as professional corporations because the law is developed enough that we can make these people, if they're going to have a PC, well, you've got to also have an insurance sufficient, and it's always got to be enforced, sufficient to pay all reasonable claims. All right, so backing up, I'm sorry. On this trust and estate deal, if somebody dies, we maybe have, Dr. Bob or Dr. Steve says, when I die, all my assets go into my trust. And then the trustee manages those assets for a while and then pays them out. Or can manage them as long as by beneficiaries say, hey, keep managing it. If any beneficiary wants to walk away, we can just walk them out of the trust, blah, blah, blah. Well, if we've got a buy-sell agreement in place, it may be that, let's just say my part of this is worth $1 million. Well, it's really not that easy to get $1 million overnight. Maybe what we do is we have a buy-sell agreement that says, pay me out 50 grand per year over 20 years with a 3% interest or a 5% interest or a 2% growth, whatever we work out, so that we get time value of money, but all these other people are able to stretch out that payment plan so that they're not hurt when one or two partners dies. It gets a little dicey if we're all getting old and we don't have any new people coming in and all that kind of stuff, but it may let us work that buy-sell agreement in a better way. In an insurance class, I'm going to talk about life insurance as a funding vehicles for buy-sell agreements, but I think we'll save that for that other class. But you should know that we may be able to get life insurance on each other, and if one of us dies, that life insurance is at the buyout rate or within range of the buyout rate. We hand it to the widower. Notice, however, that another entity cannot, so once they die, we call up the insurance company, hey, John died, we need the money. Oh, who do I make it out to? Make it out to XYZ Trust. They get the money. We're done. Boom, 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 real quick. Partnerships, corporations, or other entities cannot be part of an S corp. An S corp is designed as individuals. It does have, a lot of doctors, physicians, accountants. Those are the majority of people that I know who use S corps. It's mostly physicians, is what I know. So I've added many professional corporations. I have to admit ignorance. I'm not sure if a professional corporation, I think actually that's what a professional corporation is in most states, is it's an S corp, but it's got a state label. All right, so it's an S corp. We're going to set it up as an S corp for taxation purposes and as a professional corporation for state liability purposes, because most of the liabilities come from state law, not federal. Now, here's the big daddy, and that is corporations. This is GE, GM, Alphabet. Why is it a C Corp? Because it's Section C of the Internal Revenue Code. Why is that an S Corp? Because it's Section 22, I believe, of the, or whatever, if S is the 22nd letter, that's how it works. It just letters them out. And so this is IR Internal Revenue Code sections 300 et sequitur and that which follows. So everything with a 300 number is all about C Corps. Here's a place where the tax tail kind of can wag the dog a little bit. These are state entities. The majority of them are, the big boys are almost all in Delaware. And it's because Delaware has some really loose rules on how to incorporate, but it also has phenomenal courts on how to resolve shareholder issues relative to a corporation. Beyond that, I'm not certain we need to go into that, but you'll find this out by experience over time. Again, as we said earlier, double taxation. We're taxed at the corporate level on a corporate tax income rate. There's been some movement afoot to lower this from its current top rate of 38% down to a top rate of 25% with potentially a bottom rate of 20%. Right now, the bottom rate is 35% on the first 100,000 in income, and then you get up high enough, and I don't know where the cutoff is, you get to 38%. Once we've paid that tax, now we can do a dividend distribution out to shareholders. Well, they get taxed again. Currently, we get relatively favorable treatment depending on where you stand in the personal income tables. If you're low enough, I believe the low rate on this might be 0, and then it goes to 5%, and then I believe to 15%, and then it goes to 20%, and the top rate with Affordable Care Act in it is 23.8%, because there is, the Affordable Care Act is standard level income redistribution taxation, and so it punishes anybody who makes too much money according to the people who've passed the law. I don't know if that's really fair, but they say it's fair, so it must be, right? You know, we're probably always going to have a laddered tax system. But a lot of times this stuff of, well, just tax the rich is, as Charlie Brennan says, most of us really say, don't tax her, don't tax me, tax that guy behind the tree. You know, it's like, we can't do this. I think I've done Pierce the Veil, Alter Ego Test, but we see more of this here because we do see a lot of smaller businesses that want to appear bigger in the C Corp status, and a lot of times they are rather thinly capitalized. I'm going to pick on construction companies here because I know of a few that do this. They put all their old equipment into that C Corp and then have a different corporation where they lease the new equipment that they own, thereby, if they go belly up on any single project, they've still got their good new equipment that they were leasing to the junky place. This may be a place where the courts are going to go, no, we're going to pierce the veil here because you obviously, your liabilities, they've proven it to my satisfaction, are about $10 million a year, and you've really only got enough, about $2 million total capitalization in here, including insurance. That's not enough. We're going to pierce this. We're going to go look at this other entity that you've got set up that kind of feeds things in. So, you can play a lot of games in all of these. With a bunch of shells of corporations on top of shells of corporations. And let me talk briefly about, we see a lot of that in nursing home or senior developments, where we've got one corporation holds the land, another one is the leasing agent for all the apartments, another one we've got an LLC that does the grounds. We've got an LLC that is the nurses. We've got an LLC that's the maintenance department. And so you've got all of this interweaving of entities. And a lot of the purpose of that is oh, you didn't sue the right one of us, blah, blah, blah. And, let's play a game on the statute of limitations. So plaintiffs' attorneys are pretty wise to this and ordinarily recognize I've got to go in and I've got to, first thing I probably have to do if I think I've got a good claim is go in and unwind all this corporate mess and see who I've really got to go after. Let me make a couple more comments and then hopefully I'll be finished. It says here most complex. It is the hardest one in terms of reporting. You may have shareholders who really know nothing about the business, but just think it's run well enough that you're going to have to do this. Big burdens on publicly traded companies. I kind of skip over that. I think we talk about it in a different chapter, although I may or may not get to it. But at a smaller level where we maybe have 40 people who are all members of corporations, it's all privately held. We've still got to meet annually. We have to show them all the books. The nice thing about doing it privately held is it's not public. Nobody has to see it. If it is going to be publicly traded, and that may be our purpose in getting to a corporation, is that, because disinterested parties really shouldn't be owning LLCs. That is, that may blow it up by itself. It's possible. We can always have investor side on that kind of stuff. I think I've maybe told you this is a complex enough area. You need to get to a pretty good lawyer who can really understand this and walk you through all of this. Don't necessarily go to a generalist like me who knows a lot of stuff but doesn't know the intricate details as well as somebody who practices this 24/7. I kind of know all this, but it's sort of broad. I picked it up here and there after law school and kind of know it, but I don't know every last detail here, every last nuance. And so this may be an area as you're building things. Who do I shop? Does that lawyer know how to do all this liability stuff? And some lawyers aren't fully honest about, hey, I really don't know, and we've got to bring a team in here. Let's get a team put together, and we'll put this back up. But basically, to go to a publicly traded company, we're going to be in the SEC, Securities Exchange Commission. We're going to add a lot of burdens. We've got to publish an annual report every year. There's a lot of costs associated with this. We're going to have annual shareholder meetings. In an LLC, we're going to have a shareholder meeting over a cup of coffee because it's me and the wife. What are we going to do? Turn each other in? Not too bloody likely. We do need to, if we've got issues, discuss them, but and will we have to reveal our minutes later? Yeah, potentially. You do have to keep minutes of your meetings in a corporation. You can get away with less and less formality as you go down to that sole proprietorship and all that. I don't want to sound like I'm saying, oh, you can be sloppy in the sole proprietorship. You've got to be careful at all of these and go back to that fiduciary duty standard. If you treat all your customers as more important to you than your business, and as long as they're not trying to get over on you, you're going to likely have a pretty successful business. And a lot of this, doing it under a shell, is really so that if you take some business risk and the business doesn't really work out, you don't have to start over from scratch. You can still keep some of the money you set aside, for your own family, for your own benefit, and have the business just go under and maybe go bankrupt. So I hope I explained enough of this, and it's relatively simple. Relatively clear to you, but it is something that we do want to make sure we're going on. So let's make sure this was my last slide. I should have pulled this one out. Privately held, in compliance. Annual meeting minutes. I'm sorry, I looked at this before and I thought I was done. Publicly traded, we've got SEC. We do have the nastiness of the Sarbanes-Oxley Act, which was passed after the Enron fiasco, where the Enron high mucky mucks were stealing from their own employees and did some really nasty things to shareholders. It's, in my opinion, a little bit of an overreach by Congress. It has become the Accountancy Full Employment Act. There are so many I's to be dotted and T's to be crossed under Sarbanes-Oxley that aren't necessarily, I think in a way it's lost some of its teeth. I don't hear as many people complaining about it. I think they've kind of settled the dust down that, what we were doing before really works and we're still able to do it. We do have to have an annual meeting. We may have to send out proxy statements where each shareholder can turn their votes back over to the board of directors. I really probably ought to spend more time on the board of directors. Who are they? How do they get there? A lot of them, if you look at the big companies, there's this small group, almost an oligarchical group, that seems to run a whole bunch of the different companies. A lot of CEOs may sit on the board of 4 or 5 other corporations. Now, why would we do that? Well, they know how to run a business, and they're able to look at this stuff without being trained. All these hard to read annual reports and everything else, they can look at it, go through it, read it a lot more efficiently than I can, and know whether we're lying to our shareholders and our employees and our customers or not. But the board of directors runs the company. The CEO, so they're almost like they're almost like the Congress. The CEO executes the orders of the board of directors. And so, the boards are always, in most major corporations, one of the first questions they ask is, can we raise the dividend? Will you increase revenue enough that we can make it bigger? So they've got all these minute reporting deals, and I'm at least tired. I'm presuming you are too. I think I've covered most of what we need to talk about in that. If you have any questions, please contact me. And if you've got anything specific that I need to add, I can always make another. So it's great to see end of slideshow. Click to exit. I'm going to click stop on my magic button.